Good evening, ladies and gentlemen, and welcome to our Sunday webinar on support and resistance. One of the most important technical analysis tools or building blocks to your foundation that you can master. Now, for those of you that haven't joined us for a webinar before, ETX is a regulated provider, so therefore I'm required by law to give you a risk warning. Trading in the financial markets can result in the loss of the amount invested. Do not trade with funds you cannot afford to lose, and seek advice if you do not understand the risks. All information that's provided in the webinar is for educational purposes only. ETX Capital and the presenter are not financial or investment advisors, and we do not recommend any securities or instruments of any kind. Any securities or instruments we talk about tonight are for educational purposes only. And for those of you that don't know much about ETX, we are a fast-growing financial services company based in London. We are authorized and regulated by the FCA, that's the Financial Conduct Authority, and we're also a member firm of the London Stock Exchange. When you trade with us, if you're a beginner, you can start out with our ETX binary platform, where the only risk you have is the dollar amount you type into the screen, or if you're trying to test the strategy, it's a great place to trade. Or you can move up to trade CFDs, or if you're in the UK, you can do spread betting using our ETX Trader Pro platform, or if you want to go to the more advanced trading, you can download our MT4 platform. You can trade commodities, currencies, stocks, and indices with ETX, a regulated provider. Now, tonight's class is on support and resistance for CFDs and Forex. Although support and resistance is a concept that works in every market, at any market where prices trade in a free market. Okay. And it's one of the concepts or one of the aspects you need to master. Once you learn to read a chart and understand how to use a chart, which is the first step in technical analysis, you have to then learn to put your trend line on there. And then after your trend line is establish support and resistance areas. No matter how you wish to trade, these are the three building blocks that you need to start with no matter what you're going to do. So despite all of its fancy and exotic tools, basically technical analysis really just studies the emotions in the marketplace. In other words, technical analysis attempts to understand the emotions in the marketplace by studying the market itself as opposed to its components. And when you're studying the market, you need to establish areas around price that are critical to the market. Now, if you understand the benefits and limitations of technical analysis, it can give you a whole new set of tools or skills that will enable you to be a better trader or investor. Now, the concept, the basics of support and resistance, or the idea of support and resistance, isn't all that difficult. Support and resistance is just common jargon for areas on a chart where price has a difficult time breaking through. Support levels tend to stop price from falling below a specific point, and resistance levels act like ceilings that price cannot break above. Now, there's no rule or law that says price can't fall below or break above. They're just areas where buyers and sellers will hem and haw. Okay, but price can go right through a support area or a resistance area. But again, because price doesn't move in a straight direction, price moves in peaks and valleys, eases and ahs, pushes and thrusts, that most likely when you establish a support or resistance level, that price will hem and haw at that line. Okay, and you can develop these, and some price points are much more significant than others. Knowing where these levels are make it much easier to decide when to open and close trades, but how to locate these prices, or how do you locate these prices to begin with? Now, it is not that difficult. Okay? Support is the price or the level that holds up the prices, because that's the bottom. Whether you're selling cars and you're discounting them off there to get sales, there's a certain point that the salesman can't go any lower. If you know what that point is, you've established a support level. Okay. There's also a point that the salesman knows that you're going to resist buying that car. Okay. So if he's got support at 17,999 and resistance at 1857, he has some leeway. So when you come and start bargaining with him, there's some area in which he can play. Now, support and resistance can have many applications, can be identified also in many different ways. And this is where a lot of traders get confused. There isn't one single only way to get support and resistance. And the more we get, or the different ways we get our support and resistance levels, the more or the better we are at identifying price points that are of interest, especially when you can use several different methods and they overlap. Now, traders can use support and resistance in identification for managing risk in a strategy. Traders can also use support and resistance to grade market conditions and enter positions. One or more difficult concepts with technical analysis is grasping the premise of support and resistance. There are numerous ways to identify these levels, and even after identified, there's a plethora of ways to integrate them into your trading with them. Okay. But the basic premise is not that difficult. So if we were to say, imagine an elevator, and you're gold, and I paint you all gold, and I paint across your chest $1,250. Now you're a gold bar, so you don't have any hands. You can't push those elevator buttons in the elevator. So when the door shuts to that elevator, you have a floor below your feet. That level, or that floor that you're on, can be established. To move up, you have to break through that ceiling above your head. That's your resistance level. But when that elevator starts moving up, what happens? It breaks through that ceiling, and that ceiling becomes your floor. And then you have to break through the next ceiling. Well, just like price, since you don't have any hands or you have no control over the market, that elevator can go up and down all day long without you being able to identify where it's going to stop. But with some simple analysis, you could figure out where there might be places where that elevator will most likely stop. You know, if the fifth floor is, say, restaurants, and the roof deck is for smokers, you know, all day long those, you know, that elevator is going to be very busy going up to that roof deck. You know, around lunchtime, lots of people will be going to that floor with the lunchrooms on it or the restaurants on it. You know, in the evening when most people have left the offices and left the building, that elevator is most likely to go down to the basement and pick up the few scragglers in between. And once it starts traveling up pretty steadily, you know it's probably going to go up the roof because somebody working late needs to go up and smoke. You can start making evaluations. And this is what we do with support and resistance. Now, defining the concept of support and resistance is fairly simple. When discussing it in the context of the stock market, it defines the level at which buyers and sellers step into the market where the law of supply and demand comes into play. Imbalances in supply and demand create support and resistance levels. For example, when an overwhelming high number of buyers step into the market, an indication of support is being put into the market. Conversely, a large number of sellers indicates that there is an overhead resistance preventing the stock from moving higher. Okay. All sounds complicated, doesn't it? So let me tell you a little story. Okay. Let's go away from the elevator, and we're going to go all the way back to Chicago in the US of A, back when it was a big cattle center where all the cattlemen would drive their cattle in for auction. Now, we're going to go back 100 and some years ago. So here's the auctioneer. the cattle owners are driving their heads in. When they arrive, they get them all penned, or they get them outside of town. They go in and talk to the auctioneer and tell them, oh, we got 200 head of cattle, we got 400 head of cattle, we got 1,200 head of cattle. And then, of course, the guys, the buyers, who need to restock their farm, their ranches, or want to buy some breeding cattle or whatever else, they come into the auction. They might register with the auctioneer, but you can tell it's a busy day because there's a lot, and the right seasons. So that, when the cattle are being driven to market, they're all going to set to arrive on for Monday so they can be there all week to auction them off. The buyers going to come in on the trains. There's a train coming in from the east, a train coming in from the west, train. And, they kind of, this isn't today. There's maybe 5 trains a week. There's 3 hotels. You can tell how crowded the hotels are. You know what the weather forecast is. So, the weather at the end of the week is calling for lots of, heavy rain, wind, and everything else. So, the buyer's going to want to get in town and get out of the town before the storms get in. All of this kind of stuff. You're evaluating the market. So the auctioneer, whose job it is to evaluate the market, starts out saying, I got heads of cattle, I got cattle at 63, 63, 63. He gets no buyers. Okay. Why? Well, there's lots of buyers in the marketplace, but they're just arriving into town. There's huge amounts of cattle out there. So you have a very, very large supply. And the buyers are in no rush because they have to the end of the week. Some have to take Wednesday's train, some have to take Thursday's train, some have to take Friday's train, but they all just arrived on the Sunday train, the Monday morning train, so they're all fresh in. Okay. Now, the auctioneer, in order to start his evaluation, he went back and looked at what prices of cattle sold the week before and what prices were interested based on historical factors, like what this week was a year ago, as well as what the price was a month ago, and when he had the last, he knows how many head are out there for sale. He knows what buyers are in town. So he looks at his evaluation, buyers to sellers, and he knows at 63 he's not going to get buyers. But he's just trying to establish a support level. Okay. He's trying to find about where the buyers and sellers are today. So he goes 63, 63, gets no buyers. He goes 62.50, 62.50, gets no buyers. Goes to 62, goes to 62, he gets a buyer. He's surprised, but he gets a buyer. Why? Because there's this one buyer out there. He needs 100 head of cattle, but he needs to get home because his daughter's getting married that weekend, so he wants to get that first train back out of town. So the buyer says to himself, you know what? 62.50 is not a bad price. I could probably stick around to the end of the week and get him at 62, but I'll grab him at 62.50 and get out of town. And what have we done? We've established a support level for prices because that auctioneer isn't going to go back below that 62.50. He's going to start at 62.50 and go up to 62.75 and up to $63, and he's going to try to create more resistance levels, and he's going to try to create demand. Because he started out the day with 5,000 head of cattle, buyers who wanted to buy 5,000, but now he's only got 4,900, and one of the buyers are gone. So he's establishing price. Now, when he goes up to 62.75, he gets no buyers. Goes back to 62.50, he gets no buyers at that support level again. So he has to go to 62.25. So he gets another buyer at 62.25. The buyer says, I did better than my buddy. I just need my 100 head of cattle. That's a good price. I grab him up at, at 62.25. So he's going to go back to 62.50 now, gets no buyers again. But now he's got support and resistance. He's starting to develop a price level. Now, that's for this week's level. But what happens is when you go home with your 100 head of cattle, you run into your next door neighbor and you say, you know what, I grabbed him up fast at 62.25 is a really good price. So your next door neighbor is going to market next week to buy his head of cattle, whatever cattle he needs. Or he's going in to sell his cattle. And so he's already got a price in mind, that's 62.25, because he's got some information that everybody else doesn't have, even though it's public information. But he knows 62.25, he would sell all of his cattle at 62.25. So he's very happy to hear that. Okay. And so when he brings his cattle in 2 weeks from now, he's set at not lowering his price below 62.25. So we've got support and resistance, and we're starting to develop history, because this is what support and resistance is based on. It's based on historical information of when price was moving through these support and resistance levels. So the price levels which create support and resistance only tell half the story. We mentioned a key phrase above, overwhelmingly high. Volume is the second half of the equation. It shows us how the strength behind the selling and the buying as support and resistance levels. Why do you think I kept telling you about how many buyers were there, how many head of cattle were there? This is what creates the volume. Because you see, if you sold it at 63, 62.50, and you see there's very low volume, that means there's no really conviction out of the market. You had a fluke incident or one buyer. The stronger the buying or selling at a support or resistance level, the more important the signal is being given. Because we have blow-off tops and panic sell-offs can put tops and bottoms in the markets and mark important support and resistance levels for an asset. An increasingly popular technique for determining support and resistance can also be derived using things like Fibonacci levels. So like I said, we have many different ways to get support and resistance levels. Okay. So the basic one, which I call eyeballing, is simply to look at your charts and look for prices around the current prices that are or have been important to the markets. Then there are other tools. There's something called pivot points, which I'll show you in a minute. And pivot points are a mathematical calculation, use the highs, the lows, and opens and closes to calculate support and resistance levels. Then we have Fibonacci retracement levels, which use the Fibonacci sequence and retracements of the prior price move to some critical ratios. All of these give us different support and resistance levels. Okay. But when they overlap and when they come together at a certain price level, we can then determine how critical that price level is. For instance, I use what I call eyeballing, which is looking at historical charts, because that tells me something about the buyers and sellers. It's not a mathematical calculation. My eyeball can see historically where a price was very important. But then we have indicators, which are a great addition when looking for support and resistance level. This is because the indicators will act as a form of validation that security is approaching the support and resistance level. Since support and resistance levels act in a cylindrical fashion, meaning the price will bounce off of the highs and the lows of the range, oscillators fit best. Oscillators, like support and resistance levels, will bounce from one extreme to the next. So there are indicators like RSI and stochastics that work very, very well with support and resistance. Okay. So let's go over and try to see what we're talking about on charts a little bit. So let me pop you over. We're going to look at 3 charts which are live. I can take you over live chart. I just screenshotted them right before class because it's easier not to. I can't draw on the live charts as well. Okay. But let's get to them, and then we'll go back. Okay, so there we go. As soon as it gets here, we're looking at the pound. Okay. And this is a current live chart of the pound right before class. So we can see the pound is trading at 129.83. Now, this is a fairly high price for the pound because it's been trading very, very low since Brexit. And the increase in the pound, just like all the crosses with the US dollar, is because the US dollar is getting very weak. But as we can see, the pound hasn't traded in this level in quite some time. Okay. So yes, we have it in the last few days trading this level, but the last few weeks it hasn't been trading at this level. So what we have to do is we have to go back and look through longer term charts to see when price was near this level. And then when we find where it was near this level, maybe 6 months ago, maybe a year ago, maybe 2 years ago, we then look for critical junctures where the tops and the bottoms or the opens and the closes had a familiar price. Okay. And then we simply pull that line forward because support and resistance levels are based on price points, not on time. And we just pulled it because this price level will be critically important a year from now when the pound comes back to this level. Okay. Now, in this case, what I did is I found 3 historical price levels, and I dropped 3 lines. Actually, I found 3. 1, 2, 3, 4 I found, and I dropped 4 levels around the current price. Okay, so let's go over and look at the live chart, and I'll show you what we did. And this is called eyeballing. So let me pop the live chart up here. Okay, so there we go. There's a live pound chart. So when you're eyeballing support and resistance, you want to look back through history. And you want to find critical prices that were critical to the price of this asset around the range it's trading. You can find much lower, but much lower or much higher isn't going to do you much good right now. What you're trying to do is find the critical levels around the current price. So you can see I was fairly easily able to locate this price level, and look at all the times we had this price with opens or highs cutting here. Then again, more recently, we saw a critical response at this level. When we came back to here, we saw another grouping of prices around this level. So this tells us this price level is going to be fairly important. Now, it's well below where the pound is. The pound's at 129.93, and this is 129.70. So it's only 23 pips. It's not a huge difference. Okay. But then I was also able to find some tops here, and that gave me 139.09. But now I could find nothing around where the pound was currently trading. So what I had to do is I had to go back, and first what I did is I pulled my chart back to see if I could see anything around this current price. And when we do that, we can find the prices trading around at this level, around that price, and I can find some more support and I can find some more common prices. Okay, I can go back a little bit farther, and as you can see, we're pretty well far back, and the pound hasn't been as high as it is right now in quite some time. So I can also go back and change my charts, and I can go back to a 1-week chart. Okay. And we're looking at a 1-week chart. We can see that a while ago, back in 2016 in October, price was around this level at that point also. So now we can find some critical prices here that we could see that we could say would be support levels. This is where buyers have hemmed and hawed, and we've seen that the price was supported above this line. And so we can draw that line, and we just draw that line on our chart, and then we just simply change our chart back to our 1-hour chart, and all of those lines will continue forward, because it doesn't matter what time frame you're drawing them on. Okay, because the price was critically important at this price level. That's all that we're caring about. Not the time, not the day, all we're just trying to do is establish that at a certain level, there was some type of important juncture at that price. But that's it. We don't need to know why or how. We can see that on the chart that the buyers at this level a year ago hemmed and hawed at these prices, and we can establish that. So now what we have is we have 4 support and resistance lines around the current price. And as you can see, the lowest one goes from 129.70. The top one's at 123.09. That's only a range of 39 pips. And then we have one that's just 1 point below where the pound is trading. And then we have one that's 10 points above where the pound is trading. So that's going to give us a pretty good idea of, as the pound is moving, where we should see some action and reaction. Okay. I also did it here, and this is a chart I've been using for class for ages, and all the colored lines down below, as you can see, all these dashes, these were all critical levels to the euro way back when. But after the ECB meeting last week, the euro soared, and then the dollar's been very, very weak. So we're all the way at a price where the euro, we haven't seen the euro trading this high in quite some time. So I had to go back to historical charts, pulling it way back to, and I think I had to go to a 1 month chart to find some critical prices at this price level. Once I've located those prices, I just draw them on the chart. Okay. And so we drew those on in yellow, and then all I do is bring my chart back forward to the time frame I wish to trade in. And they've been brought forward on my chart. Now, what happens is when you have price having radical moves or price moving to new highs or new lows, not long-term high, but not where it's been in a long time, you have to go back searching for these levels. Because this is where, say for instance, we go back to the cattle. Well, this was during the summer season when everybody was driving the cattle to market. But then what happened is 3 weeks later, some horrible storm came in. Nobody's driving cattle to the market. And the buyers who were coming in, were coming in between the storms and wanted to get the hell out of town. And we're also getting towards the end of the season because everything was delayed by the storms. So what happens is those buyers are buying up. So what's happening is now the auctioneer is starting out at 66, 66, 66 because 63 and 62.50 were a long time past. And for him to do his evaluation, he's got to go back and look at his historical price records of how he doesn't care about the weather. He cares about the end of the season, how many buyers, how many sellers are, and supply and demand to come up with where he should be starting. And the buyers who are coming there realize there's less to choose from, and it's the end of the season, and they need a buy, so they're going to be willing to buy at higher prices. And this is established by historic means. Okay, that's it. Then we can go back on to, let's take me back to my PowerPoint here. Okay, after we go on to that, we can then add a second level of support and resistance on our chart by using what's called pivot points. And this pivot point chart I'm using in front of you is just a screenshot from the technical analysis site at investing.com. Now, any site that gives you a technical analysis has a pivot point chart. It's not a secret web and it's not a secret tool. The calculations are standard. Okay. You need to set them because they're based on time frames also. You need to make sure the time frame on your pivot points are equal to the time frame on your charts, like you're looking at a 30-minute pivot point. You can also go to investing.com or a million other places, or you can download them, pivot point calculators. And all it does is ask you to fill in some price information, and then it does all the calculations. We'll spit these out for you also. Now, pivot point calculators will give you 3 levels of support and resistance above and below the current price. Okay, so these are done by mathematical calculations. So what this is telling us is the support is always, because now remember, the market is the exact opposite when price is coming down. And so all you have to do is imagine an elevator. When you're going up in an elevator, the floor is your support, the ceiling is your resistance. When you're coming down in an elevator, you're breaking through the floor, and the ceiling is your support, and the floor is your resistance because you have to break through those floors. Because the system does these calculations, but they're always support and resistance. So support is just defined as the level under the current price, and resistance is over top of the current price, and it's based on the assumption it is up or down. But once you got them on a chart, because they replace each other. So we have right now 129.88, 129.80, and 1300. So if we want to go back to our chart and want to draw these on there, it's giving us a better definition of where we are. But we have our eyeball ones at 29.90 92, and then we have one at 29. And at 29 at 130.03, and this gave us This gave us 129.80 and 1300. So all it's done is to find us more points. So we can write those down quickly. And there's also charting services that will drop these right on the chart for you. 129.80 and 130. So we're going to go back over to the chart, to the live chart. For the pound. And we're going to go draw a line on it at 1, and we're going to put these in yellow. Actually, we'll put them in blue. So we're going to go to 129.80, and we drew our blue line on there, which is support, which is supporting the price above our heads. And then we have 1300, so we'll go draw another one at 1300. Right there. So what we've done is we're now more precisely developing lines of support and resistance around price. Now, personally, I don't use pivot points. I don't use things that give you just general mathematical calculation. When I started trading 40 years ago, everybody eyeballed because we didn't have computers to do all of this stuff. And I much prefer eyeballing. But a second set of pivot points, and especially if that pivot point is right at my price point, or I will sometimes build zones. What I'll call this is the area between the two as my price zone. So if I were looking to put a entry point, I would use something in between, or I would wait for it to go above theirs and below mine, or you have to decide how you're going to use them, what value they are to you, because eyeballing is very personalized, because it's research you've done yourself or your own eyeballs establishing this price. Okay, and it gives you a unique ability to make the price chart your own, where pivot points are mathematical calculations that everybody has. Now, if you wish, you can also do something like drop Fibonacci levels on here. And Fibonacci levels, you take the prior trend, you pull it up here. And this has given us, so we have a very strong 50% retracement level at 129.68, which is right by our level. And we also have a retracement level here at, it's hard for me to see, 130.06. So the 130.06, 130.03, 130.00 are very congested levels. They're very tight. The whole thing's different of 3 pips. So it's going to tell us that we can expect something to happen at that level. We can see at the 23.6 level, look at how many times prices hit that level here at the 23.6. So if it was climbing, we could expect to climb up to the 130.52. And if it soared through there, which I doubt if it will, to 131.27, but this might help us set a take profit point or a resistance point. It depends on which way we're trading. But we can see, look at all of those prices that hit that, the Fibonacci retracement level there. We also have the green level here, the 50%, and look at how true the 61.8 held in the support level here down in this critical area. So we can see that Fibonacci's, everything is kind of packed it in there. So now what you have are 3 pieces of information, and then you can add that together with your volume, which is down on the bottom of the charts. And we can see the volume is pretty holding steady as the pound has moved back up. Volume dipped during the downtrend, but as this pound moved back up, we saw volume raising pretty steady. So that means we still have a good momentum for an upward movement. So these are some of the ways we can use support and resistance. So let's go back to my power plan. Let's talk about some rules, because you have to have some understanding of rules. You can't just go flip-flop all over the place. Now, remember, support and resistance work well with other indicators. Okay, you don't want to just use them alone and make trading decisions, but there are lots of technical analysis, black box trading systems, or app trading systems robotic that are based on support and resistance. But now, what you have to understand is the more time that price bounces off the support level or falls back from the resistance level, the stronger these support and resistance levels become. Sometimes it creates a self-fulfilling prophecy. The more often it happens, the more likely it is to happen again. So imagine, I don't know where Apple's trading today, but you saw Apple trading at 139, 139, 139, and every time it climbed up from 139 to 139.50, but it got close to 140, it exhausted itself and bounced off. Went up to 139, 139.60, 139.70, 139.80, 139. Couldn't break that 1400 level. But for some reason, you got some bad news about Apple, it dropped to 136. So you said, I'm going to buy Apple at 136. That's a good price. Hasn't been that low in years. So you bought up a couple thousand shares of Apple. You need to set your level of where you're going to put your take profit point so that you get, where you're going to get out of the market. You have to establish where you're going to get out of the market to establish your risk factor and reward factor. And so you say, look at that. I don't think it's going to break that 139, 140 level. It hasn't been able to. So we're going to put our target point at 139.50, but we'll put our take profit point at 140, because if it hits 140, we're going to be pretty safe, but I doubt that. So I'm going to set my support, my risk and reward ratio at 139.50. Okay, so you're going to stay in that market till it climbs to that 139.50, or somewhere between there. You bought it at 136. Why did you buy it? If you just say, well, Apple hasn't been that cheap in years, how do you know you're buying at the right price? Well, if you could see it hit a resistance level, a support level at 135.99, and it bounced off of there coming back up, most likely it's not going to fall below. So it's a good opportunity to enter the market at that point. So, but you have to validate these. Now, understanding the concept of support and resistance, trading ranges, breakouts, and breakdowns can be quite valuable to all traders. Support and resistance is one of the strongest and most dependable tools available to a trader. Remember that it is best to use any tool along with other indicators when deciding whether or when to exit or entry points. Support and resistance analysis is an important part of trends because it can be used to make trading decisions and identifying when a trend is reversing. So if any of you have come to our class on the trend is your friend, what does a trend line do? A trend line establishes support and resistance, especially support, because a trend line is drawn underneath price movement when price is moving up. And when you hear about price can't break below that trend line, it's because then it's breaking its resistance level. So if we look back here on a Euro chart, okay, this is, let's go to a 30, we are at a 30-minute chart. Okay, this is where the Euro has been trading. This is a chart going back for a week or two, back to 7.4. And I originally established a trend line back here. Okay. Now, originally, this is the trend line I had established. Okay, because why? 2 points in common. We pulled it out in the future. Now, price is trading all the way up here, but when this was established, this was a very valid trend line. And this is the trend. Now, what we're expecting is the trend line in an uptrend works to support the price. It holds the price up above the trend line. And if you remember, price moves in thrusts and eases, thrusts and eases, thrusts and eases, thrusts and eases. So there's a good chance that we're in the middle of an easement, and if we're expecting this easement to come down, it's going to come down also as far as that trend line, because we've established a very good trend line. And if you notice, it's never been broken below that trend line. So what is it doing? It's establishing another definition of support. So it's supporting the price above that level. Okay. Now remember, you can have medium-term trends, longer-term trends, shorter-term trends. Okay. And by using your trend lines, you've now got Fibonacci retracement, you've got pivot points, and you've got eyeballing, and now you have trend line support. And trend line is done with a very exact set of rules, so you know if your trend line is now. So let's take the pound that we've been looking at, and can we establish a trend line on the pound? Now most people would probably like to draw the trend line here, but the problem is at one point it could have been driven there, but once price fell below that, it could no longer be held. It can't be established because what's one of the Furman's rules of trends? Price cannot break a trend line. So if we want to draw a trend line on here, a current trend line, and see if we can get one that's validated, and actually this is a very nice trend line. Let's just get it out of yellow. Let's make it a color you can see. Or usually, let's use dark purple here. And let's get, I just try to make it easier for you guys to see it. There we go. Now what's happened is we actually have a valid trend line because we have 3 points in common. We have 1, 2. This is where we would have drawn our trend line, but until we get the third touch of that trend line, it's not validated. And here we got it validated. So this tells us it's a very good trend line. So we can pull that out in the future. So, but it's supporting that price above that level. So we have all different types of support. So we have support, support, support. And there's many ways to get this. And all you're looking for is if we can pull this out in the future, we can then establish some price that's going to be critically important to that pound in the near future. And that helps us make smart trading decisions. Hold on, let me just get these markings off of here. So using a combination of pivot points, other indicators, you can tell a story. Most experienced traders will be able to tell many stories about how certain price levels tend to prevent traders from pushing the price of an underlying asset in a certain direction. For example, assume that Jim was holding a position in Amazon and that he was expecting the value of the shares to increase. Let's imagine that Jim notices that the price fails to get above $39 several times over the past several months. And even though it has gotten very close to moving above it, it doesn't. So in this case, traders would call the price level near $39 a level of resistance. Now, determining future levels of support can drastically improve the returns of a short-term investment strategy because it gives traders an accurate picture of what price levels should prop up price of a given security in the event of a correction. Conversely, foreseeing levels of resistance can do the exact opposite. Now, the more times that price hits that resistance or the support level, the more important or the more significant it is. Okay. It should also challenge the trend. Okay. Whether it works against a trend, when you see it go against a trend, then it's telling you the trend might be ending, or it supports the trend and it can tell you the trend's going to continue on. The critical thing is to verify support and resistance. Now, support can reverse and become resistance. So in other words, when we see here price moving down, it bounced off the support level, bounced back up, came back to the support level, but then it broke that support level. That support level, as price was moving back towards it, became the resistance level because it's a level where price should have a problem breaking above. Can't say it won't, but it's a price we want to watch. When it bounces off that resistance level and comes back down, then it starts moving back up. We would hope it would come up to that resistance level. So you can start making some important market decisions and trading decisions based on those prices. Now, as we can see here, the more times that price reacts to a certain level, the more important it is. Again, we saw price moving down, established a support level, bounced off it, came right through it again, then went above, but then fell right back down. Then moving back up, it topped out it again, fell back down, but then it moved right back up and fell off of it again. That tells us that that price level is critically important. Okay. Now, remember, the most important thing is to verify or validate your assumption. And you do that by looking at volume. You want to see if volume is working in conjunction with those support and resistance levels. If you're not seeing any change in volume as price moves to those resistance and support levels, buyers are paying no attention to them. Now also time matters. The more recently a level has been established, the more useful it is. The problem with the current bear market is that quick losses had many traders looking well into the past for support levels. Unfortunately, grasping distant history is not always useful. Sometimes when you have to go back a year or two, sometimes 3 or 4, to establish that price level because it just hasn't traded near there. Like when the euro did fall down to 105, 106, 107, it was very hard because we hadn't seen those levels hardly ever. And so you had to go back many years ago, just like when the euro is bouncing up and it goes up to 140, we haven't seen a level like that in many years. So sometimes what happens, even though you've established it and it's a good level, the whole market psychology and everything else is not so helpful. So it doesn't mean it's a wrong level, it just means it's not as useful. So support and resistance levels are key mile markers in a security's progress. When you're developing trading strategies, consider these points on a graph. Do so will help you set profit targets and prevent frustration when eventual reversals occur. Support and resistance doesn't have to be confusing. You can mix and match any of the methods above and create a healthy amount of price levels that we can trade. As always, practice makes perfect. So thank you very much for joining us. Have a great weekend. The new August calendar is posted on ETX. And if you notice, we have a whole bunch of new classes coming for you in August. Things that we haven't studied before. We have Bollinger Band strategies. We have market trend. We have trend trading strategies. And I forgot the third class. We have lots of new, MACD. So we have lots of new classes coming up for you. So make sure you join us in August. And thank you very much for being part of ETX. Have a great weekend now. Bye now.